Good day, and thank you for standing by. Welcome to the Avanza's Full Year Report 2025 conference call and webcast. At this time, all participants are in listen-only mode. After the speaker's presentation, there will be the question and answer session. To ask a question during the session, you need to press star 11 on your telephone keypad. You will then hear an automatic message advising your hand is raised. To withdraw a question, please press star 1 and 1 again. Please be advised that this conference is being recorded. I would now like to hand the conference over to our speaker today, Gustaf Unger, CEO. Please go ahead, sir.
Good morning. With me in the room in Stockholm today, I have Carolina, Head of Investor Relations, Adnan, who has been our CFO during the interim period, and last but not least, Jonas Svärling, our new CFO, I hope not CEO, who will go through the financials after my initial presentation. So warm welcome to you, Jonas. The best news of the quarter was that Avanza, for the 16th year in a row, has Sweden's most satisfied savers, according to the Swedish Quality Index. It's also fantastic that we again ranked number one in every subcategory. Avanza's overall score was 77.6, which can be compared to the industry average of 70. Avanza's Net Promoter Score remained highest in the industry at 41, while the industry average was at 3. I'm especially proud of this achievement considering our scale and that we're growing, which makes it increasingly challenging to maintain high customer satisfaction across a customer base of over 2.2 million. We were also recognized as an employer, where we were ranked as one of Sweden's most attractive employers by both Karriärföretagen and Universum. And attracting and retaining top talent is, of course, essential to execute on our strategy 2030. In Universum's survey, we also ranked 11th among those with over 8 years of IT experience. This is fantastic since the market for senior IT expertise is limited and highly competitive. It is also impressive that our savings economist, Felicia Schön, was honored during the quarter as Savings Profile of the Year and Digital Rising Star of the Year, which is a confirmation of her influence as a powerful voice in personal finance. On top of this, our new podcast that was launched this year, called Inga dumma frågor om pengar, ranked top 10 most listened to podcasts on Spotify during 2025. We have also delivered new products at high speed, with several long sought-after features now launched. With a focus on stock market enthusiasts, we now allow unlimited switches between brokerage fee classes, which is benefiting active traders who make transactions of varying size during the trading day. It was previously possible to switch brokerage fee class once a day. Customers who use manual currency exchange features are now paid dividends in local currency instead of automatic exchanges to Swedish krona. Also, the analysis tab on the stock pages now include forward-looking estimates. For our private banking clients, savings for children was improved to allow policyholders of endowment insurance to set the age for transferring their wealth to an heir, which private banking customers in particular have asked for. Something that we have wanted for many years is to be able to offer mortgage LTVs of 85%. The way that the Swedish mortgage market is currently structured, many customers find their savings locked in with other players in order to get a better mortgage rate. I'm therefore very pleased that we, as of this quarter, now offer mortgages with an LTV of 85% through both our external mortgage partners, Stabelo and Landshypotek. And as our CTO Fredrik spoke about in the Q3 presentation, our target for 2025 within the cloud journey is to have migrated at least one production service to the cloud environment. And we reached this important milestone this quarter. And while this may seem like a small step, it means that everything is now in place for a broader migration. And last but not least, now adding the Q4 results, we can conclude that we are at all-time high full-year results. 2025 turned out differently than many of us had expected. I started the year with high hopes for the future, which was quickly turned upside down in the light of geopolitical turmoil and tariff chaos. The stock market climate with rapid and unpredictable turns has been tough for many customers to navigate in, and market statistics for the first 9 months of the year show that Swedes deposited more than twice as much in savings on a net basis, but invested significantly less in equities, fixed income securities, and funds compared to last year. This suggests that a large share of savings was stuck in current accounts with the universal banks during the year. We welcomed over 170,000 new customers and had a net inflow of 54 billion, despite these challenging markets and despite the wind down of our external deposit products. The lower rates and the expansionary fiscal policies speak for a turnaround for the Swedish long-term savings market in 2026. And although long-term savings might not have been accelerating the way we would have hoped during 2025, trading activity did increase compared to 2024, as always well connected to market volatility, as you see top left. Bottom left, you see that the number of brokerage-generating customers increased going into the year and has kept stable at a high level, showing a broad participation in the markets in 2025. Top right, you see the increased appetite for foreign securities trading, and bottom right, you see the need for our customers to further reduce their big home bias, which speaks for a continued trend towards foreign securities. When comparing our performance with the targets, we have overall done a good job. We did have Sweden's most satisfied savings customers. Our colleagues showed a strong engagement with an eNPS of 57. We produced a return on equity of 40%. The board is proposing a dividend of 76% of the profits, and the cost to savings capital ratio was further reduced from 14.5 to 14.1 basis points. Our savings capital growth of 13% just fell short of the 15% target. The cost increase of 10.4% was in line with our indication of 11% for the year. And on the sustainability side, our sustainability score was improved during the year, but we still have large potential in helping women to save more. With respect to our target to grow savings capital by an annual average of 50% through 2030, we fell slightly short with a growth of 13%. The target was set knowing that growth will be lower in certain years, and this year our net flow contributed less than we had wanted. One reason is the ongoing process to close the external savings accounts, where we started the fall to close accounts belonging to partners that are actively migrating the remaining deposits to their own platforms. In early 2025, just before we announced this move, there was nearly 43 billion of our savings capital in these accounts, of which over 26 billion now has left the product. We estimate that 55% of these 26 billion has stayed with Avanza. We also expect to retain approximately the same share of the remaining 16 billion. Retaining more than half of the volumes we decided to phase out says a great deal about the strength of our brand and that customers want to consolidate their savings with Avanza. On the other hand, it also means that we expect our net inflows to continue to be offset by around 8 billion in outflows due to the wind down of external savings accounts until the process is completed in late May 2026. During 2025, we have progressed well with executing on our strategy across all 5 pillars and the target fulfillment I discussed earlier. I think there's strong engagement and energy among my colleagues for the way forward, which is important. Jonas, you have been with Avanza exactly 2 weeks, so I'm certain that you know every financial number inside out by now. Over to you, Jonas.
Of course. Thank you, Gustav, and good morning, everyone. Great to finally be here. Before we move on to financials, I thought it would be good to just briefly introduce myself. As you said, Gustav, I joined Avanza as CFO just 2 weeks ago, And joining now is really exciting given what has been set out in our strategy 2030 and the quite ambitious growth plan. And if you add to that Avanza's market leading position in Sweden today and also its great culture, it was not difficult to say yes when you offered the job, Gustav. So my views on operational efficiency, scalability, and volume and customer growth ambitions, etc., are a little bit too early, obviously, to talk about. However, what I have experienced in the first weeks is the culture. I think I've never seen such joint or common and clear commitment, or I should rather say passion for savings and investment and actually bringing that to customers. And that goes across the whole company. And that really stands out to me, how people here love making great savings products and also helping each other. I joined from SEB, where I spent more than 21 years in different finance, risk and treasury positions, as well as in different Swedish and Nordic CFO roles. Most recently, however, I co-headed SEB's retail and business banking operations in Sweden, including the branch office network, the telephone bank, and the digital banking app and web channels. I hope I will be able to add some knowledge from being responsible for all Swedish private customers, including the smallest private banking segment and also smaller corporates. And before SEB, I co-founded an IT consultancy firm and also launched a hedge fund. So I originally actually worked as a programmer, given my engineering background. So I look forward to meeting and talking to all of you later, but now let's get into the financials of Q4 last year. And speaking of joining at exciting times, of course, it is extra good to be here presenting the financials as we're reporting record full year results with both trading and interest-related income streams contributing to that. We're also reporting quite a strong Q4 with operating income in line with previous record levels. However, as we have planned for and also guided for, we're also increasing the cost this quarter, resulting in an operating profit of 733 million, which is still strong, although 10% lower than Q3. If you look at the full year costs, they came in at a 10.4% cost increase, 7 million or slightly below our guidance of 11%. All in all, net profit is up by 17% compared to last year, and return on equity at a healthy 40%, meeting the ROE target of at least 35%. Earnings per share is at 16.57, up 16% compared to 2024. Now, let's look at the income side, and here we still see a stable and healthy income mix with some underlying trends that we'll dig into. It's been, as Gustav said, a little bit of a special year with quite volatile markets, and as usual, volatility correlates quite well with customer activity, and as a result, we're seeing trading-related income accounting for an increased share of revenues compared to last year. At the same time, NII has remained stable despite lower market rates. Altogether, this has resulted in, as said, in all-time high revenues in 2025. If you look at Q4 specifically and start with brokerage income, trading activity held up well, although we saw a little bit of a slowdown in December, where we also had quite a few days when the stock market was closed. There were actually 4.5 fewer trading days in Q4 compared to Q3, which contributed to a 4% decrease in brokerage income. Adding to this, the brokerage margin then decreased slightly to 11.2 basis points, down from 11.4, as private banking and pro customers had a higher share of the brokerage, 26% compared to 24% last quarter. When it comes to foreign trading, that high interest remained throughout the year, apart from a short-lived dip in April. And in Q4, the turnover in foreign securities accounted for 30% of brokerage generating turnover, and in absolute numbers, it was the second highest turnover in foreign securities ever, resulting in a strong FX income in Q4. Moving over to fund commissions, we're seeing some margin pressure this quarter, with the share of index funds increasing to 50.6% by the end of the period. The fund margin decreased to 24.4 basis points on average and was at 24.0 basis points by quarter end. And when it comes to the margin, the split between active and passive funds is one explanation, but also what type of index funds our customers choose to allocate their fund savings towards can also have an effect. As you talked about, Gustav, we hope for a stronger Swedish economy in 2026, and we also see that in signs in terms of fund savings, where we're seeing Swedish index funds among the most net bought during the later part of the year. These are in general priced lower than those with international exposure, thus lowering margins. However, when it comes to funds, volumes are growing, and despite the negative margin development, we have an all-time high fund commissions, both for a single quarter and for the year. Lastly, other income was weaker in Q4, explained both by decreased income from several smaller and different income streams, and on the other side as well, several other smaller commission cost lines that are not reported separately. Part of this is related to the income from external savings accounts, which is a volume-based distribution income, which naturally then decreases as we are closing down these accounts, as Gustav highlighted. Also, costs for payment commissions increased as a result of more people logging in when markets were quite shaky, which means increased costs for bank ID usage. Income from corporate finance also decreased, while the income from Avanza markets increased. If we move over to NII, the importance of our growing volumes is once again demonstrated. Despite 100 basis points lower policy rate today than going into 2025, full year NII remains stable compared to 2024, thanks to increased both deposit and lending volumes. This applies for the quarter, where we are seeing a volume-driven increase of NII despite the latest and possibly last policy rate cut on October 1st. If you first look quickly at the lending side, we reduced the rates on margin lending by 13 basis points following the latest policy rate cut. The mortgage rate, however, is directly tied to the policy rate and was consequently reduced by 25 basis points. The combined effect of these two rate changes led to the average rate for internally financed lending decreasing to 2.81% from 3.01%. We believe we have quite an attractive offering when it comes to mortgages, and we have also done some extra marketing, as you will see later in the cost part, towards private banking clients, and we're seeing some quite nice results of that in mortgage volumes that increased by over 1 billion in the quarter, mainly related to private banking customers. Moving over to interest cost side, interest expense for deposit increased some due to the higher internal deposit volumes and an increased share of deposits that are on interest-bearing accounts. That was at 58% compared to 54% last quarter. This was to a large extent then offset, however, by the lower deposit rates, which will also decrease with the policy rate cut on October 1st. And the average annualized rate on deposits was 0.76%, 4 basis points lower than last quarter. To summarize, NII remains a stable contributor to income mix, and as said, the volume is the key driving factor. The Riksbank is estimating unchanged policy rate going forward unless there are changes to the outlook for inflation and economic activity. This would indicate a more stable rates and thus margins going forward, all else equal. Moving over to costs. The full year costs increased, as I said before, by 10.4% compared to 2024, meaning that our spend has been 7 million Swedish krona lower compared to the guidance of a cost growth at 11% 2025. The slightly lower costs are explained mainly by us being able to keep the cost for the cloud journey below budget, and to some extent also by our work on operational efficiency, where we have been quite successful in reducing external spend during the year. Looking specifically at Q4, we are at 24% higher cost than Q3. That's an increase we flagged for when reiterating our guidance in the last quarterly presentation. As I'm sure many of you know by now, our staff costs are seasonally low in Q3 due to vacation debt being reduced, and as a result are now comparatively higher. In addition to that, we had more consultants on site, mainly tied to the cloud migration. And on top of that, the marketing costs are up quite substantially this quarter compared to the very low levels Avanza is usually at. Our very strong brand and our customers' high willingness to recommend us is typically how we drive inflow through word of mouth. However, we do not have the same brand recognition when it comes to private banking and occupational pension, and that is why we increased our marketing initiatives towards these segments, which, as you saw earlier, improved, for instance, lending to the private banking segment. It is quite important, though, to note that this quarter's cost level should not be seen as the new quarterly run rate for marketing costs going forward, although we will continue to work to build brand awareness as part of our efforts to grow within private banking and pension. This reasoning also applies to the full cost base, where not all of the cost increases in Q4 are recurring running costs. If we look into the future in terms of cost then, our long-term target is, as communicated before, an average annual cost growth of 8% up until and including 2030. And as said, this cost growth will be higher at the beginning of the period as we're investing within our Swedish growth initiatives with the aim to reach 5% by 2030. This implementation of our strategy, that continues at full speed, and we forecast cost increase by 9% in 2026, driven by continued investments in accelerate growth in Sweden. The planned investments, they include work to develop our private banking business and the launch of our new discretionary portfolio management product, as well as investing in our pension business. It also includes all the continuous work within our core business to make sure Avanza stays in the forefront when it comes to offerings and the user experience. The cloud journey also continues, where you mentioned that, Gustav, that we're reaching quite an important milestone during the quarter when we migrate our first production service to the cloud, meaning that everything is now in place for a broader migration. And in 2026, the work will be focused on migrating services that we find suitable and easy to move at a controlled pace. We are, of course, not immune to inflation, which will drive some of the cost growth as well. Our work on improving our internal efficiency is quite important to offset this. Total salary adjustments are expected to amount to around 4%, which, when you consider staff costs as a share of total cost, yield a cost increase of somewhat above 2%, as illustrated on the slide. Summarizing, our cost increase is related to investing in further growth, and we continue our work to improve internal efficiency to be able to meet the planned volume growth with an improved platform. Avanza is built on scalability, and we are at a leading position when it comes to cost to savings capital ratio, and we intend to maintain that position. The target is to decrease the cost to savings capital ratio over time, and in 2025, it decreased to 14.1 basis points compared to 14.5 basis points in 2024. Finally, and concluding, a note on capitalization and the proposed dividend. Avanza is well capitalized with prudent margins, both the leverage ratio, including Pillar 2 guidance, and the total capital requirement, including risk-based Pillar 2 requirements. The binding constraint is the leverage ratio, and even though our deposit volumes on balance sheet has increased substantially during the year, largely driven then by the closing down or external savings accounts, we still have a healthy margin to leverage ratio requirements, which, should be stressed, very poorly captures the extremely low risk profile of Avanza's balance sheet asset side. Taking this and the strong result into account, the board has decided to propose a higher dividend per share compared to last year of 12.75 krona per share. This corresponds to a payout ratio of 76%, which exceeds our target of 70%, but also leaves us with capital flexibility going forward. And concluding, and maybe repeating myself a little bit, as you can see, we still have good headroom to the total leverage ratio requirement of 3.5%, including the Pillar 2 guidance of 50 basis points, which, as said, is the most constraining requirement for us. This gives us a position where we can handle increased deposits of 32 billion Swedish krona before reaching it. And with that, I will hand back to you, Gustav, for some closing remarks.
Thank you. I again start the new year optimistic about the future. May sound strange given what's happening around us with Greenland, but we have received positive signals on inflation and that personal consumption is starting to grow. The Riksbank's policy rate of 1.75% is a whole percentage point lower than that at the start of 2025. And this is important for Swedish households who are more rate sensitive than in other countries, where we typically own our homes and we often have variable rate mortgages. The government has issued an expansionary budget for 26, which is likely to help the Swedish economy to finally gain momentum despite continued global uncertainty. I believe and hope that this leads to 2026 being a year when households actually have more money left in their pockets, which should be positive for the Swedish savings market and for Avanza. Now we're happy to take questions from you.
Dear participants, as a reminder, if you wish to ask a question, please press star 11 on your telephone keypad and wait for your name to be announced. To withdraw a question, please press star 1 and 1 again. Please stand by while we compile the Q&A queue. This will take a few moments. And now we're going to take our first question. And it comes to the line of Martin Ekstedt from Handelsbanken. Your line is open. Please ask your question.
Thank you and good morning. Jonas, first, welcome on board. Could I direct my first question to you, please, and ask what will be your first priorities as CFO, including, I'm sorry for making this sound like maybe a job interview question, specifically in relation to finding a new home market for Avanza before 2030. What is your experience of cross-border M&A and, for that matter, establishing new markets organically? Thank you.
Yeah, thank you, Martin. Lots of questions in one go. I may be disappointed in saying that as joining as CFO, I would initially dig into all the numbers. For me, the most important priority right now is listening to customers and meeting all the staff of Avanza, really understanding where we are right now and what is needed. Then, based on that, I will spend more time on digging into the financials and what can be done related to that. Then you also asked about the experience in terms of M&As and international expansion, also where we stand on that. I think in general, when we have something more to communicate related to our international expansion, we will do that. I cannot add more related to that. Other than it's part of our strategy 2030 to grow internationally. That's also one really exciting thing about the Avanza growth case that attracted me to Avanza when Gustav and I had conversations related to that. Having worked in SEB for 21 years, there have been numerous occasions where I've been involved in different cases in terms of both buying or divesting different types of businesses. Some have happened, some have not happened. Those that haven't happened, obviously, I cannot comment on, but there have been a few acquisitions that have been disclosed publicly where I've been working behind the scenes. On top of that, I was CFO for a Nordic business, the Nordic SEB Card Banking Group, for a couple of years. So have some experience running across Nordic business as well. Hopefully that answers some of your questions.
Loud and clear, thank you. And then for my second question, this quarter you actually for once reported material loan loss provisions, 4 million, which looks like 5 basis points of lending annualized. That's not exactly low for a portfolio of Swedish private banking mortgages. I just wanted to ask for some further clarity on that one. Doing some archaeology around these numbers, it looks like you haven't reported provisions on this level since 2011, and your report still states that you have no realized credit losses attributable to events after 2011, end of quote. So I assume it's the no realized part of this statement that is key, right? I.e., this is a new provision and not the realized loss. Is that correct? And could you just give us some more added comfort around this, that it's not the start of the more pronounced peak in credit losses? Thank you.
Yes, I can comment on that. And it is exactly as you say, it's related to expected credit losses, not realized credit losses, and it should not be seen as an indicator of generally increased losses or risks in the credit portfolio. It's stable and healthy low. This is related to one single stock producing in estimated values related to Intelligo Technologies related to our margin lending related to that stock, which explains almost everything of the increase in expected credit losses.
Okay, so it's on the margin lending side. Great.
Yes, I will make very conservative estimation of that.
That's all from me. Thanks a lot.
Thank you. Now we're going to take our next question. And it comes to the line of Jacob Hesslevik from SEB. Your line is open. Please ask your question.
Good morning. Let's start with the net flows during the fourth quarter. If we take your 55% take rate on external deposits, it means roughly 11.7 billion has left the platform. And if I remember correctly, 3 billion had left as of Q3, meaning that outflow accelerated during the fourth quarter. In October, you had strong net inflows of above 5 billion. Does that mean that the majority of the outflow occurred during November and December, where the numbers were a bit weaker?
Jacob, I must admit, I don't have the monthly numbers of the external deposit account flows in my head. But I mean, November, December were weak. They were clearly weaker than we hoped and planned for. 25 was a very challenging year for long-term savings. A lot of deposits were stuck with the universal banks that I mentioned, and during the fall, so some of the partners have been had less appetite to retain volumes, and some partners have fought for it more. Let me put it that way. And the latter of the year was more challenging partners from our perspectives.
Yeah, but Gustav, if we think about it in this way, in total, roughly 12 billion has left your platform, correct? And in Q3, you wrote that 3 billion had left, so it's 9 billion during the fourth quarter alone. And if we assume that Avanza usually have natural net inflows of roughly 5 billion per month, we see that in November, December, you had roughly 500 million. But if you divide up the 9 billion that you had in outflows, it's 4.5 per month. And 5 billion in natural net inflows less the 4.5 outflow gives you the actual monthly data that you reported for November and December. So is it correct to assume that the majority of those 9 billion went out in November and December, and that's why you only reported 500 million in net inflows?
My recollection is that I was disappointed with November and December also taking the external deposits account into account, so to say.
Okay. Yeah. But if we then move forward, looking instead, you have roughly 16 billion left on the external deposit platform, and with your 55% take rate, it means that just above 7 billion will leave up until May. Can you help us understand if these 7 billion will be more front-loaded or back-loaded, or should we expect it to be equally spread out per month?
I think we've guided 8. I mean, it's a rounded number, but no, I don't want to stick out my head and say, you know, which month. And so it's an ongoing dialogue with our partners. We want to make this, as I think we've done in 2025, a good experience and controlled experience for our customers, but also for these partner banks who, to some extent, are dependent on this funding. So, but we still stand with the view that we will be done with this closure by the end of May.
Okay. But if we have so little visibility on these outflows, I think I speak for all analysts on this call when I say it would be very helpful if you could clarify and show in your upcoming monthly statistics per month how much of the net inflow number was affected by outflow from your external deposit platform.
It's noted, Jacob.
Thank you.
Thank you so much. Now we're going to take our next question. Just give us a moment. And the next question comes to the line of Patrick Bertellus from ABG. Your line is open. Please ask your question.
Thank you. Can you hear me?
Yes.
Perfect. So my first question would go to Jonas, who is the new kid on the block. As you were announced quite much earlier than you joined, I reckon that you have followed the company from the sidelines. Could you talk a little bit from your point of view, which are the biggest areas of improvement potential that you see now entering the firm?
Thank you, Patrick, and also for calling me kid. It feels always good for a 47-year-old man, so thank you for that. Yes, it's been 6 months on the sideline. However, I did stay and support SEB a little while, so it's actually only 2 months fully on the sideline. but still, and only having access to public and external data, and previously then competing with Avanza in my previous role, it was always with a little bit of envy how Avanza attracted so many customers and so much saving capital, and what was the secret sauce behind it? Was it the user experience itself, maybe a function of culture or whatever was it? So that was, I was also always then wondering, how can it be improved? Because when you look at it from the outside, things look quite well in terms of both financials and flows, etc. So that was maybe my sort of key question, sort of what are the efficiencies, what are the changes that can be made to further improve this? Because if you listen to Gustav, if you listen to Sven, how they talk about the company, there are still lots of things to do, both with the core business in Sweden and when it comes to international expansion, which is obviously a separate and interesting growth case. And then when you come inside, you see that we are not done. There are things to do. I think you, Gustav, highlighted that in earlier calls, that there are things we can do on the inside in terms of operational efficiency. I think Avanza has been quite good at making user experience and flows for customers strong and attractive, and I think those are customers have experienced that. There are some processes and systems, etc., on the inside that are maybe not on par with what customers experience on the outside. So I think there are improvement opportunities in that area, I would say.
Okay, great. Thank you. My next question is following up on the topic of the savings capital left on the external savings account. How do you view taking potential actions to get the larger share of the remaining capital to stay on the platform, potentially raising savings rate on your own account temporarily to keep a higher share, or how do you view that, or any other actions potentially?
Patrick, I mean, we really want our customers to consolidate all their savings with us. So we want our customers to retain all of their savings with us. When with the last rate cut, I think it was announced late September, we did not reduce the rate on our savings account fully, left a little bit extra on the table for customers, partly because we thought that this may be the last rate cut and let's share it a little bit more with customers, but also with the external savings accounts in mind. So no, we don't have any concrete things in mind here and now. I think we're doing a pretty good job to guide our customers to make the right choice, and I think we have an attractive internal savings account.
Okay, fair. I understand. And my last question, if I squeeze in a third one, is that the other commission income line is down quite a lot sequentially. You talked about the drivers here, but can you elaborate if any effects here are temporarily, or is this the new base level as it is like minus 26 million in the quarter?
All except one important factor are not a trend, but rather this quarter. But one is clearly a trend, and that is that we have and we will continue up until end of May book the income we get from our banking partners for distributing their external savings deposits, and that of course naturally goes down as volume goes down. But the other ones are more fluctuations in market. We saw more interest from customers to log in, which increased the cost for BankID, which shows up as a negative income on that row. So I would say the savings account effect will continue and will be there forever, but the other ones are more market related.
Okay. Thank you.
Thank you. Now we're going to take our next question. And the question comes to the line of Marcus Sandgren from Kepler Cheuvreux. Your line is open. Please ask the question.
Morning, guys, and congrats, Jonas, to your new position. I was actually looking a bit more on the longer-term trends. If you look at the transaction activity in relation to savings capital, it's clearly going down over the years. On the other hand, it has been both much higher volume traded in foreign currencies, and also the price per trade is going up steadily in the last couple of years. Can you talk a bit about the dynamics for the coming years? What do you expect in terms of pricing dynamics and trading in relation to savings capital and so forth, please?
I mean, if you take a long time series, Avanza was started directing towards the very trading-oriented, trading-interested Swedes. Today, we have more than 2.2 million customers, which of course, some are very interested to be active on the exchange, and some they want to buy a fund or a few funds and then be very happy with that allocation. So the mix of customers have changed if you look over many years. Looking out in the future, I think it's very challenging. It is so market dependent. The only trend that I dare to be clear on, that is foreign exposure. Our customers have a way too big home bias still today. Almost 80% of their securities portfolio is exposed to Sweden. That is not a good geographical diversification. We will see over time further interest for foreign securities. That is my view.
Okay. And if I put the question like this, then that the reason for higher average price per trade, is that driven by larger volumes per trade or by high share of foreign securities, or is there anything else?
I would need to dig in and get back to you, Mark. I haven't thought around it from that angle.
Okay, very good. Thanks.
Thank you so much. Now we're going to take our next question. And the question comes to the line of Andrew Lowe from Citi. Your line is open. Please ask your question.
Hi, thanks for taking the question. The first one is just on your net brokerage margin, and particularly on the expense part of that equation. So your brokerage fee expense was 15.3% of brokerage income, having previously been between sort of low 14s and then mid 14s in the prior year. So it had been quite steady, and it jumped up a lot in Q4. Could you just explain what drives that uplift and whether that uplift is recurring or we should expect it to come back down again? The second question is if you could maybe just provide a little bit more detail on the Q-on-Q drag from other income from your lower external deposits, or maybe just if you could give us the fee margin that you earn on those deposits, that would be really helpful. And the final clarification is just how much of your 300 million of transformation costs that you called out a year or so ago was spent in 2025? Thank you.
Hard questions, Andrew. On the first one, I need to get back to you. The second one was around
Other income and the external deposits.
Okay, so we would like to give you transparency on this, and we would like to have done that already in early 2025, but our hands are tied with the agreements we have with our partner bank. So we have not, and we will not disclose, the margin that we earn on that product. But what can we say on the other income line? It's hard to, with the hands tied there, it's a little bit difficult to answer. The third question was
how much of the 300 million transformation cost was spent in 2025?
Oh, yeah. I mean, we indicated in going into 25 how our cost increase of 11% would be distributed. And you can use that, and also what Jonas said, that we are slightly below our budget for the cloud journey for this year. I haven't that number in my head, but it can easily be calculated backwards by those numbers, Andrew.
Okay, great. I understand about the ability to disclose, but worth a try. Thanks so much.
Thank you.
Thank you so much. And now we're going to take our next question. And the question comes line of Haley Tam from UBS. Your line is open. Please ask your question.
Morning. Thank you very much for taking my questions, and I add my welcome to Jonas as well. Hopefully you can hear me okay. My first question, I'm afraid, is just to follow up on the external savings accounts, but if I ask perhaps a different way. The 55% retention rate, thank you very much for giving that number, and also I would really be interested to understand what underpins your confidence in that 55% going forwards, because I might have anticipated that some of the earlier volume changes might have been from partners who did not intend to keep the deposits. So really any color you can give on the mix of the types of partner going forwards or measures, as I think was previously asked, would be helpful to understand the confidence in that 55%. And then the second question really was just a follow-up on what you said about the foreign trading and then how that should continue to increase going forwards. I just wondered whether you've seen any sort of short-term impacts as likely this year, given the current geopolitical tensions, whether you've seen any evidence of any kind of shift in attitude amongst your clients since the start of this year towards US stocks in particular. And then the third and final question, if I may, was just about the launch of the discretionary mandate solutions. I just wondered whether you could give us any update on the feedback you've had from your private banking clients, what kind of expectations you have for uptake and speed of rollout once you start that, I think, this quarter. Thank you.
Thank you, Haley. Now, first question was around savings account. So, I mean, you and your colleagues pushed us already a year ago to guide more on how much of the volumes would Avanza retain, and we didn't dare to do that. We don't want to guide unless we are fairly certain. We feel fairly certain enough to guide you now on that we expect to retain slightly more than half of this retaining 60 billion. What is that based on? It's based on a close dialogue with all the 6 out of 7 partners who still have volumes in this product. The data we have on client behavior, data we have on clients that actively take a choice, data we have on clients who do not make a choice, i.e. there comes to an agreement between us and the partner bank, what happens with those volumes. So we feel fairly comfortable. It's always a little bit scared to stick out your head looking into the future, but unless we were not certain enough, we would not guide you. The second question was around, help me here. Foreign trading. But you asked a little bit for now, right? Of course, we have a lot of insight what's happening right now, but I think we are very transparent with our monthly statistics. What I can say and what I think we published, out of the 5 most traded foreign securities, 4 of them are net sold year to date. In general, volatility is good for trading. Do we see volatility in the US? We typically see more trading in the US. What we saw, though, in April, with the Liberation Day, we saw a little bit of flight from US exposure into European exposure. So we saw that effect. So we try to be close to customers and guide them and help them in these challenging times. I think there was a third question.
On the discretionary mandates.
On the discretionary mandates, it's too early to say. I think we have a number of customers who are willing to develop this product with us. and a lot of customers have wanted to participate, and the feedback we've gotten so far is very positive. But the market is not out. The product is not out on the market yet. We're working according to plan with it. I look very much forward to market launch later this year.
That's very clear. Thank you very much.
Thank you. Now we're going to take our next question. And the question comes line of Ermin Keric from DNB Carnegie. Your line is open. Please ask the question.
Good morning, and thanks for taking my questions. Maybe if we start on the net flows, but disregarding the Savings Account Plus, more in general, what do you feel that you could do to drive the underlying net inflows to be stronger? And do you see any indication that competition has impacted it? Again, underlying, disregard the Savings Account Plus.
I think there's a lot we can do. I think there's a lot we do, but there's a lot of things we can do better. I think a lot of volumes have built up with the salary accounts with the big universal banks. I think we can improve in trying to activate these customers' savings. There's a lot of pension money that sits with inexpensive solutions. I think we can do a better job to help our customers to move into more cost-efficient solutions, which they can find with us. We had a very good pilot on the occupational pension side in Q4. It's not seen in the numbers yet because that takes a little bit of time. But yes, so the short answer is yes, there's a lot of areas where we can improve, and we're slowly but surely doing that. There was something connected to that.
Yeah, I suppose, like, do you see that it's been competition impacting it being a bit slower than you expected for 2025 generally? If I just take one example on Pro, it's not major numbers, but now you've had outflows for 3 consecutive months, for instance.
Yeah, if you take the Pro segments in general, we don't see increased competition for that segment. I mean, this is a client group who they don't have a normal job, normally within brackets. I mean, they live out of this trading, so they will always have an outflow. So unless they put in more money, we will always see a net outflow, but we will always see a net outflow. But they live from this, so they need to have a better return to be able to do this. And if you look at the savings capital development, it's still pretty okay for the Pro segment. In general, we see that some customers test new players with part of their money. We have seen that with, we saw that with Saver when they were new. We saw it a little bit with Leveler. We see it with Montrose. But in general, I would say no, Ermin.
Okay, thank you. And you introduced that you could switch brokerage class more frequently now. Why didn't you just introduce automatic allocation to commission classes? Wouldn't that be the most true to kind of your DNA, making it the simplest for the customer?
I think we've done a clear improvement in Q4 for our customers. For the ones who do want to change brokerage class, it's very few of our customers who want to actively do that. It's something that's been sought after for quite a while. It was actually a little bit tricky to do technically, and that's why it's also taken some time. When it comes to pricing in general, I think we have a very attractive offering. I think the average cost for a trade done with us in 2025 was like 11 krona. I think it's very cost efficient to run your portfolio with us. Having said that, of course, we want to constantly improve the offering towards customers, be it either through better functionality or to even more efficiently run their portfolio.
Got it. Then the last question, just on the mortgage side, we see that on your internal private banking mortgage, you've seen growth ramping up per quarter now. You mentioned you've done some marketing. Is that what's already driving it? Is it the market? And kind of what should we expect from here in terms of growth on that product?
I think it's a combination of us being more visible with our private banking brand. I mean, for the whole group here, our own mortgages are only available to our private banking customers. So that is one factor. The other factor, which is not quarter to quarter, but if you look a year or two back, I mean, the funding cost relation to the universal banks has improved for us. So, I mean, in relative terms, our rates are more attractive today than a year or two ago. So I would say it's those two combinations.
Great. Thank you very much.
Thank you. Now we're going to take our next question. And it comes to the line of Enrico Bolzoni from JP Morgan. Your line is open. Please ask your question.
Good morning. Thanks for taking my question. So if I look at your customer growth has become a mid to high single digit annualized growth on a monthly basis, roughly, while historically you grew much stronger. If I look at your target of growing saving capital by 15% in Sweden over time, conscious of these, in a way, deceleration in customer growth, can you please help us to break down the 15% in its key components? By that I mean, could you tell us how much you expect in saving capital growth will come from new clients joining the platform, how much from market appreciation, and how much from flows? And lastly, a bit of I try. I'm not sure if there's an answer to that, but going back again to the customer growth, do you have an idea of your market share of customer growth when it comes to clients that in Sweden every month, every quarter, every year open an account with a digital platform like yours? So just to get a sense of how much of the front book growth you're capturing in terms of customer growth. Thank you.
So if your last question was our market share among new customers, with the sub-segment of the Swedish savings market, i.e. only the digital players, then I don't have that number. That we don't have a market number, so it's hard for us to estimate. But I would say it's aligned with our market share on the existing customers, and then it's very high. But we don't have market statistics on that sub segment, Enrico. The first question.
Decompose 15%.
Oh, right. So what we have said, which we still stand by, is that the 15% is decomposed in market appreciation of 5%. It is then 10% remaining in net inflow. And of those net inflow, we estimate that the Swedish savings market will have net inflows of 3 to 4%. So we will capture those, and then we will need to steal market share from competitors equivalent to 6 to 7%, adding up to the 15%. We know that we have a big potential to have our customers move a larger share of their financial wealth to us. And on top of that, we have the growth of new customers, which was 8% this year.
Thank you.
Thank you. Dear participants, if you would like to ask a question, please press star 11 on your telephone keypad. And now we proceed with the next question. And it comes to the line of Philip Mollman from SB1 Markets. The line is open. Please ask your question.
Good day and great to see you in place, Jonas. Welcome, and thanks for taking my questions. Firstly, following up on Ermin's first question, what can you do to activate the money sitting in current accounts and are not deployed in the markets? What are some triggers you see available to you? Can you hear me?
Yeah, it is a tricky one. But and I think it boils down to the Swedes' belief about the future, if it's bright or if it's scary. And if it's believed to be scary, then you don't take long-term decisions, which long-term savings is. But I think there is a clear opportunity for us, since we believe that volumes has piled up with the current accounts with the big universal banks. So that, of course, is reflected in how we communicate with our customers and with the market now and going forward. But I don't want to go into the details to hand that to our competitors, how we're planning to do that.
Sure. Makes sense. My second question goes to you, Jonas. It may be a little bit too early, but we'll try. With the increased deposits on your balance sheet, you state that you can now take on additional 32 billion of deposits before reaching your requirement. My question is, with both the remaining migration, we expect around 8 billion of inflows, and with the continued growth of savings capital, how do you think about your capital position going forward and long term as well?
When the board proposes the dividend as indicated here, then we have taken into account volume growth, both from the underlying business as well as the inflow of additional deposits from the closing down of savings accounts. That's already included. We also, throughout the year, obviously will have, if things go according to plan, a growth in capital due to growth in income. So the accumulation of capital from profits will help offset to a large extent the increase of planned deposits, both organically and then those from the close down of the Sparkonto Plus product. Then we're obviously continuously looking at optimizing the capital structure of the group and the different companies within the group. We will continue looking into that in 2026.
Sure. Okay. My final question is on NII. With the increased internal deposits that initially goes onto the balance sheet, with an increase in NII quarter-over-quarter in the first quarter that fully reflects all rate cuts, which is great. While other income or the distribution fee, it had some noise as well, but are reduced by the less distribution fee from partner banks. How should we think about the relationship between lower fee income from partner banks and higher NII going forward, both in terms of numbers and in terms of quality of income streams?
The only thing that I want to say there, Philip, is that the decision to close down the external deposit product was mainly driven by the fact that the product had passed its due date because of the new view from the Swedish FSA. Having said that, and what we have seen during 2025 and what we expect for 2026, it is net positive for Avanza's P&L.
Okay, great. Thank you.
Thank you. And now we're going to the last question for today. And it comes to the line of Andrew Lowe from Citi. Your line is open. Please ask your question.
Hi, thanks for taking a follow-up. A quick one. Could you maybe just elaborate a little bit about how you're feeling about crypto and sort of potential to do something there? Lots of your peers are implementing stuff, so it would be helpful just to have a recap of what your thinking is with this asset class. Thank you.
If I start with looking back at Q4, I mean, we offer exposure to cryptocurrencies through ETPs. We saw the activity being modest when I compare to previous quarters. Having said that, we continuously look at our overall offering, and of course, this one, your question, is on our table. Me personally, I'm a bit divided, as I've said before. There is client demand. On the other hand, I've been educated my whole career to look at investments from a cash flow perspective. But it's on the table and looked at.
Thank you. That's really helpful.
Thank you. Dear speakers, there are no further questions for today. I would now like to hand over to Gustav Unger for any final remarks.
Many thanks for taking the time, all of you, and I hope you have a great day.
This concludes today's conference call. Thank you for participating. You may now all disconnect. Have a nice day.